welcome everybody to today's Spotlight on webinar with our guest speaker, Robert Rittenhouse. Welcome and thank you, Robert, for being here with us. He is going to be speaking to parametric insurance for climate resilience. And next slide, if you could, please, Trish. All right, so welcome. If you could please throw your name and where you're coming from or organization into the chat, that would be fantastic. And as I mentioned, we have Robin Rittenhouse here with us. My apologies. With Descartes Insurance presenting Rethinking Climate Risks with Parametric Solutions. And then we'll go into open discussion. So if you have any questions or thoughts, please throw them in the chat. Trish and myself will be monitoring that. I'll let Robert share how he wants to handle anything like that if it's different than what I said. And I will just give everyone, for those that are new, a brief introduction into who we are as Resilient Virginia. We are a statewide nonprofit with the mission of catalyzing collective action to enhance systems-level resilience across the Commonwealth. We do this by convening the 4 pillars of resilience, which we consider ecosystem services, economic activities, built infrastructure, and social dynamics, to connect people, resources, and ideas to strengthen all of the systems that support life, work, and opportunity across the state. And one of our roles is, as well, is as the state affiliate for the American Sustainable Business Network. We believe that communities equipped to lead have the power to exceed resilience benchmarks and create adaptable, lasting solutions for a sustainable planet. And thus we are here hoping to share some insight, experience, and education about ways to do that. So on to Robert Rittenhouse. Thank you so much, Robert.
Really appreciate you guys having me here. Excited to be speaking today. I'm going to go ahead and take over control and present my my little slideshow here for everyone. So going to ask for a quick verbal confirmation that everything is looking right here once I enter presentation mode. Are we looking good?
Looking good.
Okay, perfect. So as Jess and Trish mentioned, I'm Robert Rittenhouse. I am with Descartes Underwriting. Been with Descartes for about 2 years now. Prior to this, I worked in more of a traditional insurance background, working on property. So so Parametric, super interesting. It's a completely different way of approaching risk. And along with that, we have a lot more flexibility in how we can tackle these climate-based risks. So before we get into the nitty-gritty, wanted to quickly go over what you guys can expect for the next 30 to 35 minutes or so before we open it up for Q&A. So first of all, really great job for a lot of you folks. Multiple people reached out to me prior to this event. So with questions, introducing themselves. So based on that, it looks like we have a good mix of folks that have maybe placed or purchased Parametric, and then some folks that have never really worked with it before in the past. So I'll try to accommodate all of those backgrounds as we're going through things here. But if at any point you want further clarity on anything, raise your hand. Let Jess or Trish know. Since I'm in presentation mode, I can't really see all that, but they'll flag me down. Feel free to stop me. I'd like to have this be as conversation as possible, even before the Q&A. But then we're going to shift gears going into the growing challenge. This is really going to focus on climate volatility and the recent growth of events, really painting a broad picture of why Parametric is in the insurance marketplace and where this all came from. Going a little bit deeper into section 3, we're going to be looking at specific coverage gaps and limitations that exist in the current marketplace and some of our solutions for those. Also going to look at an in-depth look of NFIP and FEMA, as they specifically pertain to climate-based risks. And then section 4, we're going to dive into, a couple of examples of what our parametric structures look like. A little bit of rubber meets the road here, if you will. So going to dive into that. And then we're also going to go through some real-world examples of how parametric is enhancing resiliency in communities in Virginia and elsewhere. And like I mentioned before, opening up for Q&A shortly thereafter. So What is parametric insurance? So parametric insurance is a completely different way of viewing risk than your traditional, let's say, homeowner's policy, for example. So if you have a homeowner's policy and you sustain, let's say, $10,000 in damage, you would go to your carrier and say, hey, I sustained $10,000 in damage. Adjust this loss. They would go through the adjustment process. They would assess the loss. It would be subject to deductibles, terms and exclusions, sublimits, all that super fun policy wording that I'm all sure we read before buying an insurance policy, and then you would get your payout. So with parametric insurance, this is an index-based policy. So essentially what we are doing at the end of the day is we're triggering off of the event itself, not necessarily that dollar loss at the end of the day. We try to correlate those as much as possible, but because we're triggering off the event, it allows us to get more creative with how we insure these solutions, especially as we look at public entity business, governments, local, state, federal, whatever it happens to be. Just provides us a lot more options. We have a lot more levers to pull, if you will, than a traditional insurer does. So for example, we would trigger off of a hurricane or peril specific. So hurricane, rainfall, snowfall, earthquake, wildfire. Think of those things when you're thinking of how we trigger these policies. Like to shift gears onto underwriting focus. When we look at our underwriters versus more of a traditional underwriter that you might find, a traditional carrier, our underwriters are, data scientists by nature, and they all have, specialities in climatology, seismology, meteorology. So obviously these folks are a lot smarter than myself that are designing these structures, pricing them out. But further than that, when we have an opportunity to work with one of you guys or your brokers or whoever it happens to be, lending our underwriters to that conversation where they are true subject matter experts really goes a long way. So our underwriters are not your typical underwriters, and they are based in our Paris, France office for the most part, which I'll get into a little bit later. I'm going to skip over a little bit of technology and data because it all kind of feeds into the back testing that you'll see in the point below. So back testing is really important for us, and we'll get into more specifics as to why that is a little bit later on in this presentation. But essentially, back testing is demonstrating how our parametric structures or policies would have reacted for prior events. So let's say that you were some sort of entity in Tampa. We would look at Helene, Milton, Ian, going all the way back to the 50s and 60s when we actually started recording this data. And we could tell you what the parametric payout would or would not have been for each of those events. So that helps correlate with what your actual experienced losses were. Maybe you had a high deductible. Maybe you have terms and exclusions. Maybe you have an uninsurable interest. Unfortunately, as we'll get into, a lot of folks don't carry hurricane or wind insurance at all in these cat-prone areas. So, this really helps demonstrate not only how efficient the covers are, but it shows, this thing actually works, right? So I'll combine the last 2 points, then we'll move on. But claim settlement process and then immediate indemnification is a huge function of parametric. So because we're not triggering off of the actual sustained loss and we don't have an audit process, our claims turnaround time is 1 to 4 weeks. Great example is with Hurricane Melissa that recently impacted Jamaica. All of our policies that have been impacted have been paid out at this point, which is, fantastic for our claims team. But really, our clients are able to, get on their feet a whole lot quicker. And, all of this before adjusters have even been able to set foot in those locations for most traditional markets. So looking at who is Descartes, who are we? Descartes is now the largest sole Nat Cat parametric provider. There's multiple parametric types of insurance within the marketplace. Life insurance, for example, is a parametric policy. We focus solely on natural catastrophe perils. With that in mind, we can do over 20 plus. We never want to say exactly which ones we can't do or can do because, really, if there's anything that has a data set, we're able to do it. Our most common ones are obviously, your earthquake, hurricane, wildfire, excess rain, river flooding. I could go on and on, but this is certainly not an exhaustive list. If you have any sort of natural catastrophe or any sort of nature-based index, we can take a look at that. We have over 400 policies globally, over 200 million in gross written premium. And as I mentioned before, about 200 of our underwriters sit in our Paris, France office, with quite a few of us over here in the North America team, as North America seems to get a little bit of every single peril, whereas, other parts of the world might only be subject to a couple. If you even look like a state, like Texas, there's probably 10 major events that happen every single year there, and it's unlikely that they're going to be the exact same peril. So the growing challenge, this is going to kind of dive into why Parametric has kind of hit its stride over the last 5 to 10 years, why it's being incorporated into so many programs, and why we are seeing the success that we are. So there's a lot of information on the screen. I don't expect you guys to absorb even half of this. This is really just to illustrate the gap between the insured loss within the marketplace as well as the gap in uninsured losses. So as you can see, especially in countries outside of the US still has an unacceptable gap, in my opinion. But as you look at these gaps, not only is that gap widening year after year, but what we're seeing is that the communities that are often most at risk for these natural catastrophe events are both underserved economically and underserved by the insurance market itself. So not only are they often not able to find affordable insurance for these natural catastrophe events because of the frequency and severity increases over the last decade or so, but oftentimes they can't find it at all. That's especially true outside of the US, because in the US we do have the NFIP program and a couple of others for flooding specific. But that's really the core of what this slide is hoping to show is Parametric is able to provide solutions where the traditional market just is either unwilling to or is cost prohibitive. So we don't decline based on where you are. We'll give you a structure and a quote regardless of your location. So this is getting a little bit more granular here, and a lot of this is specific to the US marketplace, although it does apply elsewhere. So severe capacity constraints, for those of you who aren't super familiar with insurance and might not understand what that means, capacity is essentially a measure of how willing carriers are to enter a certain insurance marketplace. And that is represented by, essentially reinsurers who are giving their capacity and giving the ability for these companies to write that insurance. Without that, they are unable to or unwilling to. So we saw this recently. The last 10 years have been what's called a very hard market for the property market, which means that pricing is increasing, terms and exclusions are increasing, which we'll get to in the third point here as well. We're starting to see pricing coming back down. Thankfully, we've had no landfalls of major hurricanes in the US this year. So we're seeing some markets come back in. That being said, the final 2 points where we talk about non-damage business interruption and increasing terms and restrictions and exclusions, those are actually eroding for a lot of insureds or holding steady. So when we mentioned non-damage business interruption, this really pertains more to private clients, ones that are not in the government sector, although the concept can still be applied to private sector and to government entities as well. So essentially, for the example of non-damage business interruption for a commercial client, a hotel in Tampa, for example, especially if it's a newer construction, they're going to be fairly well hardened. They can sustain a much higher intensity of storm than some older buildings can. Let's say their building is untouched by a category 3 storm, but everything else around them is completely destroyed. Because that building did not sustain any physical property damage, their traditional business interruption coverage is not going to kick in on their traditional policy. So we have many clients that purchase our Parametric covers specifically for non-damage business interruption. But really what I want to highlight here as it pertains to resiliency within communities is that we are very flexible with how our loss dollars are spent. So whether that is building back with resiliency in mind, as we'll talk about living shorelines a little bit later on, or indemnifying communities that are unable to afford insurance for either economic reasons or insurance market conditions. Moving on to the third point here is increasing restrictions and exclusions. This comes in the form of deductibles, sublimits, exclusions, just general policy wording. Another thing I want to bring up too is just that the adjustment process itself within traditional insurance introduces basis risk in a way that Parametric does not. Different adjusters, unfortunately, will interpret policy language and causes of loss differently than the adjuster to their left, even if they're with the same firm. So all things to keep in mind here. As we talk about claims management, I've hit on that a little bit, just how quickly our indemnification process works. But essentially, since we are triggering off the event and we're using data providers that are well known, established, we can check to see whether or not a loss has occurred in real time. So typically, the biggest holdup for us when we are looking to pay out these claims is waiting on the client or the insured to come to us with a statement of loss and get all their ducks in a row, just because they're having to do so much following a loss. So we've talked a little bit about market gaps and limitations kind of on a broad scale, but I wanted to dive a little bit deeper into some specifics to give you guys some additional context. So if I haven't mentioned it before, non-damage business interruption not covered in the traditional market. As we look at the claims process following Helene, less than half of these claims have been closed either with or without payment as of June 10th of this year. This highlights a couple of things, right? I mean, looking at the gap between not only folks that did not have coverage, but folks that had insufficient coverage, or that, had full coverage, but that claim is still taking time to be paid out. Unfortunately, it's not uncommon for claims to drag out longer than 6 months and go into, points where we're measuring them by years instead of months, especially with natural catastrophe events where we are looking at kind of a spreading thin of adjusting resources from these companies. So specifically as it pertains to natural catastrophe insurance, that quick indemnification and liquidity that Parametric brings to the table is incredibly and increasingly more valuable. Traditional insurance only allows clients insurance to replace, not rebuild stronger or more resilient structures. I'm from Virginia, grew up here my whole life, and we have a lot of unique history here. Unfortunately, especially as you get into more coastal towns that have been established for a very long time, or even Richmond, a lot of these buildings were not built with sustainability or resiliency in mind. So, when you look at a traditional policy, you're only getting indemnified up to the point where you're able to rebuild, not rebuild with today's standards of resiliency and strength. And this is especially important when we talk about living coastlines and traditionally uninsurable interests. So think about docks and other just kind of outdoor buildings that are just completely uncovered, and these tend to bear a lot of the brunt in these natural catastrophe type of events. I have a specific slide where we'll go into living coastlines in more detail. So if you're not familiar with the term, we will cover that in just a couple of minutes here. So NFIP, as I mentioned before, is the National Flood Insurance Program. They write 95% of the U.S. flood insurance policies. Because of the government shutdown, they're currently unable to accept new and renewal policies. And, I think this really just speaks to the level of uncertainty that, not only commercial clients have been feeling recently, but now government entities as well. This goes beyond NFIP when we start looking at FEMA as well. I know there's been a handful of news articles recently that have highlighted the fact that, government entities as well as private sector just do not feel as certain as they once did that FEMA, NFIP, or any other government entity is going to be there in the same way that, we could count on them 10 years prior. A lot of that just comes down to, budget cuts and increasing government dysfunction. So, when you think about where you currently have coverage gaps within, traditional programs, it's important to not only just look at some of these exclusions and coverage gaps that I'll talk about here that are bullet pointed down below, but think about just the uncertainty risk that comes along with relying on these government-backed entities as, in most cases, your sole option for insurance for natural catastrophe insurance. So specifically with NFIP, I won't go down this entire list, but outdoor buildings, basements, temporary living expenses are completely uncovered under this program. Max limit of $500,000 for the building and $500,000 for contents, so $1 million total. That might sound like a lot on paper, but especially if you are a private or public sector entity, that goes very quickly. And then for personal clients, folks that are just homes, that's $250K for buildings and $100K for contents respectively. So even lower there. And there's a 30-day waiting period for the policy to kick in, whereas we do not have that same exclusion. And there's no coverage for earth movement because of flooding, which essentially just means if you are sitting higher than a river, that river erodes below you, but the water never actually gets up to the structure. There's no coverage, whereas we're able to design structures that would actually trigger off of that river height itself as opposed to the water level actually reaching the property. So not going to spend a ton of time on this one. I think this is just really interesting to further demonstrate the gap between insured loss, uninsured loss, and also demonstrate that, communities and areas that traditionally have not seen, these are two flooding examples, but have not seen natural catastrophes impact their area, or certainly the perils that they're seeing. It can really happen anywhere. So up here on the top left, we're looking at the 20 flooding. I was actually living in Omaha, Nebraska at the time, and seeing some of this damage firsthand was, unfortunately very eye-opening. This was a result of excess snow melt 3 states away. It can really come from anywhere. We're seeing a lot from severe convective storms, hurricanes, storm surge, excess rainfall, snow melt, whatever it happens to be. So unfortunately, in a lot of these cases, these entities or residents are not purchasing insurance for any of these perils because they don't know if they need it. And oftentimes they haven't needed it for maybe centuries. So we're looking, and governments are becoming a little bit more savvy to this, and we're interacting on more of a state and federal level to implement programs, so we're not left in a situation where there's just this huge gap between an uninsured loss and the economic loss that follows. And I think these last 2 examples down at the bottom, Helene and Harvey, these are obviously fresh in a lot of people's minds. Areas where we wouldn't expect to see the amount of flooding that we saw. Now, I think Western Virginia goes kind of under the radar for the impact of Helene as well, with obviously how awful things were in Western North Carolina. So these are things that directly impact Virginia as well. So wanted to just highlight, this truly can happen anywhere. So relying on governments to provide policies and having parametric support that is something that we really take a lot of pride in here in providing those solutions. So I've talked about our solutions a lot. Here's a couple examples of how we approach risk. So first of all, when you're looking at this, you might think this looks pretty simple. This is essentially what our policies look like. And that's really one of the key functions of Parametric, is that it's meant to be transparent, as easy to understand as possible. I would much rather look at this than look at, a 50-page, deck page from a traditional market. So what we have here is about as traditional a cover as you can, or market standard, if there even is such a thing within the parametric risk space. This is what's called cat in a circle. Specifically, this one's for hurricane. You'll see cat in a circle mentioned again when we touch on wildfire. But what we have here is 3 concentric circles at 20 miles, 20 to 30, and 30 to 40 miles. And based on the proximity of the track of the hurricane, along with the intensity, as you'll see here, these 11 or 111 to 130, 130 to 157, and 157 above, that's category 3, category 4, and category 5. So based on proximity and based on intensity, that will generate a parametric payout. One thing that's really important to understand here is that all of our policies are bespoke. You probably will never see another one of these structures that's exactly the same from one another, just because we do a really good job of solving for specific problems or gaps within a traditional policy or within a government entity. We're not trying to be a broad solution for every single peril. So with that in mind, we could have 5 circles up to 50 miles. We could have 1 circle that's 70 miles. We could have, cat in a triangle, cat in a square. We could have a cat in a hat. It really does not matter. Everything is on the table for us. We are very flexible with how we offer terms. We could go all the way down to starting coverage at a category 2 or category 1. All of these things impact our pricing at the end of the day. So we try to strike the best balance between cost of the coverage and the coverage you're actually receiving. And a lot of that comes back to the back testing that I mentioned earlier. So looking at prior loss data and saying, okay, you sustained $1 million in damage from a category 3, we would mirror our structure. And when I keep talking about structure is this compensation grid here. So we try to structure these policies such that it will pay out accordingly to what your actual experience losses were. And the hope there is that that will also correlate with what your future losses are, along with the proprietary modeling that our underwriters, have so much pride in, and that we, that's what we bring to the table. So for a specific example of how this would have paid out in this instance, For any weather nerds like myself, this is the track of Hurricane Andrew. This was a Category 5 storm, which was in the second most circle. So calculation is fairly simple. This would be a 60% payout of the limit. Just like most insurance, we're a limit-based product. So, let's say, for example of this, 10 million in coverage at a 60% compensation ratio. That's a $6 million parametric payout. Like I said, that's payout that'll be paid out within 1 to 4 weeks. So, this structure is, generally fairly easy to understand. There are a handful of other ways that we can approach this risk if there are other things outside of, potentially wind or, anything else that you guys are interested in. But another thing I want to draw your attention to before moving on to the next slide here is the data provider. So this is National Hurricane Center. We really strive to use data providers that are, not strive, we always use data providers that are impartial, third parties, but we really strive to find data sources that are independently verifiable by the insured following the event. So this is a type of policy where you can see mere hours after the event has occurred what you're entitled to under your parametric policy. So not only knowing what you're entitled to, but being able to, get that declaration of loss out, begin that indemnification process, the better everyone is off. And, lending transparency into the insurance market has been a long fought challenge for the traditional market. And this is a great solution that we on the parametric side are able to provide. Hail, really quickly, hail is not by far one of our most commonly asked for perils, but I do want to highlight this because of the resiliency impact that it does have. Our primary targets of business on this are solar farms and wind farms. So because of that, we tend to see a lot more, technical approach to these types of things, but with this being said, our trigger for this is a little bit different than our hurricane in that there's no proximity trigger. This has more to do with the hailstones that were detected over the coverage location here, which you can see is outlined in this quadrant. So what we utilize radar technology to measure the largest hailstone size that was measured within the swath, and that would generate the parametric payout. So this is really more of an intensity trigger than anything else. So this one can be a little bit easier to understand, but we are seeing a lot of traction as we move, away from carbon-based, energy production and moving into, more renewable projects, which these are popping up all over in Virginia, which is great to see. So we are seeing a lot more traction on that front. Parametric wildfire is the last one I'm going to touch on. Like I mentioned, we do over 20 perils. So if there's anything that you guys want, clarification on afterwards, I'll leave my contact information and, please feel free to follow up. So wildfire is probably our easiest product to understand in that, there's no intensity trigger. It's just a proximity trigger. So with a wildfire, there's no stage of wildfire, right? It's not like, oh, this was a stage 1 wildfire, I would expect this amount of damage, or stage 3. If there's a wildfire in your property, you're going to experience darn near total loss, if not a total loss. So this is what we call a binary trigger, meaning that it either pays out the full limit or it does not pay out the full limit. So in this specific example, what we utilize is a 100-meter buffer around the coverage area. Typically, it's not a single point. We see a lot of HOAs and we see a lot of forestry projects where they're doing carbon capture and carbon buybacks and things of that nature. So it typically won't be a single circle like this. It'll look some sort of like oblong shape that has a 100-meter buffer around it. But what we'll do is, following a wildfire event, we'll utilize Sentinel-2 satellite imagery, and this detects a 20 by 20 meter pixel resolution. If there's a single burn scar pixel within that coverage area, it is a full payout of the coverage limits. So fairly easy to understand. This does pertain more to commercial clients, but when we look at more of HOAs or even looking into public sector, we do have the ability to take a look at a larger coverage area, and instead of assigning it to be a binary trigger, we could have a percentage area burn type of approach where we have a coverage area, and then based on the amount of bird scar within that coverage area, that would generate the parametric payout. So that one would be actually severity based. But don't overcomplicate things here. Just this is all to say, these are some of the basic approaches that we can take when we look at these wildfire and other peril risks. So this is where the rubber meets the road here. This is a great example of parametric in action. And this one hits close to home because this is something we're seeing a whole lot more in the Chesapeake Bay area with living coastlines. Living coastlines, living shorelines are typically, think of salt marshes, just general marshlands, swamp area, mangroves, natural structures that not only support biodiversity, carbon capture, but they also absorb far more energy from hurricanes and other storms than unnatural hard coastlines like bulkheads and levees and other concrete structures, which sounds a little counterintuitive, but when you actually take a look at the data, these resilient coastlines, these living coastlines do a much better job of not only insulating at-risk communities, but bringing a lot more revenue in terms of biodiversity, opens up industry. There's a lot of benefits to having these living coastlines. And why I'm highlighting this is that parametric will allow to, with our flexible loss dollars, you can rebuild with living coastlines, replacing hard coastlines, undoing all that damage that over the last almost century, we've been doing to our coastline. So we've actually had quite a few inquiries all throughout Virginia and Maryland for this specific ask. So I'm really, really encouraged to see this catching on. But one thing to think about as well is that, not only are you just, beautifying the area, increasing the, biodiversity, everything that I've already mentioned, the communities that are unfortunately impacted by these hurricanes, like I mentioned before, often can't afford insurance. It's difficult to obtain. So you're insulating those communities for the long term by implementing living coastlines, living shorelines. So these tend to pay dividends down the road as we progress and as we try to build more resilient communities. So I always hate throwing a ton of words on a slideshow here, but I really wanted to highlight three actual use cases of parametric to enhance resiliency going forward, both in Virginia and elsewhere. So we're going to look at renewable energy first. This is a quote pulled directly from one of our trading partners, Willis Towers Watson. So as we transition from coal and other greenhouse emitting means of energy production, specifically wind, hydroelectric, solar, these are all things that are dependent on nature for their long-term sustainability. So not only can we provide a financial instrument to hedge against years where they might have a downturn in production, we can partner with these firms, these groups, these government entities to help them better understand their risk. Because we have such robust modeling capabilities, and this is a space we've lived in for such a long time, we can form a really nice symbiosis with these entities that are providing, cleaner energy to, like I said, financially support their interest, but also be able to, help them understand, are we expecting less sunshine, over the next 5 years? One of the interesting things that I learned when I joined Descartes was that because of climate change, we're actually seeing less and less wind outside of the natural catastrophe stuff. So that does impact how wind farms, where they're located, where they decide to grow, where they decide to shut down areas. So being able to partner with those folks is really important for building cleaner, more resilient communities. Another thing I want to focus on, this pertains more to the private sector, but as you'll see, with the third example, it ties in really nicely with what we're able to do on a public sector as it pertains to, rebuilding these communities. So this is an actual example, a West Coast, technology company. Their building's robust, very well built, can withstand an earthquake, but they're more concerned about their employees getting back to work and being able to rebuild their lives following an event. As I've harped on multiple times, unfortunately, the communities that are most at risk often can't afford insurance or it's unavailable. So companies being able to purchase a parametric policy to, allow their, employees to get temporary housing, food, living costs, get laptops, be able to continue, getting back to normal quicker. These are all things that are able to be facilitated under parametric policy, whereas traditional policies, obviously wouldn't have any sort of coverage for this type of this type of loss. So we're able to think outside of the box and get really creative where the traditional marketplace is just unfortunately put in a box, for better or for worse. So taking a look at where this actually comes into play with communities, I've mentioned it probably 100 times now, so I'm going to stop at this point. But these communities that are unable to afford or find insurance, leaves a big gap for these governments that need to be able to rebound economically and rebound, from a social standpoint. It's unfortunate looking at what's happened, in Katrina, years and years and years ago. There's certain communities that, had some of these backstops in place, and unfortunately the ones that didn't still have not rebounded, and it's still kind of a bleak outlook. So being able to work with governments to provide a parametric solution at a government level to support their citizens and allow them to get back up and running following an event, not just economically but from a social standpoint, and that immediate liquidity indemnification goes a very long way as it pertains to these specific, resiliency efforts within communities. So I'm done hearing myself talk for a little bit. I would love to open it up for Q&A. Really quickly, I'm going to skip ahead here. So if you guys are interested in working with us, please contact us through your broker. If you are a broker, reach out directly to myself. But all of this information will be shared after. So I'm looking forward to hearing from you folks.
Thank you so much, Robert. I will let folks chime in. I'm going to, sorry, I was just looking through the chat, but I will open it up for discussion. And if there's no questions, because Robert did such an amazing job answering them all during his presentation, I will poke the bear with a few of them.
Robert, can you hear me?
Yes.
I think I'm still unsure on what the vehicle for this would be, especially for a public entity. I mean, I'm familiar with this especially in captive insurers, but that's all commercial lines. So I didn't know if there was a special vehicle that public entities could enter into, or if you were talking more about a pool for individual coverage. Could you help me with that a little bit?
Yeah, so when we look at government entities, we can look at it a couple of different ways. Governments can look to kind of use parametric to backstop their own operations, which is what we see a lot of times, which instead of just providing direct dollar relief to their citizens that just don't have insurance, it allows them to fund their own relief efforts. So this would be more along the lines of they have their own resources to be able to help folks rebuild, get back up on their feet. Maybe they have funds that are being directly funded by this parametric payout as well. So that would be one vehicle that they could use. But the example that I went to last, that was actually just a pure government is essentially transferring the risk instead of them, building a pool on their own of, collecting tax dollars for a rainy day fund, for lack of a better term. They're able to use that to transfer the risk to a company like Descartes, where we would, utilize a parametric policy to backstop that.
And what do the premiums look like for this?
It entirely depends. I would say that, since we are a rate online product, typically our net rate online minimums that you'll see is anywhere from, we'll talk about hurricane specifically. We can get as low as, 1.5% to 2.5%. But like I said, it really just depends on what we're trying to solve. For instances where we really want to backstop truly catastrophic events, where we're looking at maybe category 4, category 5, we can get fairly inexpensive at that point. But if you're looking for more of a frequency type of payout, where category 1, category 2, that's obviously going to impact pricing negatively, or I guess I shouldn't say negatively, but it's going to increase pricing relative to a more severe based structure.
And then finally, who certifies the triggers?
So we have an independent data certifier that's listed within the policy documents. So we have the data provider themselves, but then we go to that data certification agent to verify that the data that's out there and that's published is accurate. So it's different for each peril, but it's clearly listed within the policy declarations. And this is something that we would have a conversation about prior to issuing the policy as well.
Got it. And that would give the individual entities the opportunity to agree on those different certifications.
Exactly, or at least become more comfortable or understand where where we're coming from with this.
Thanks. I think that's all I had.
Appreciate the question. I see we got a question here. Do you have any models or government clients that we can learn from? You know what, I'll connect with Jess following this to send out, maybe a more in-depth, a couple of examples of things that both Descartes and maybe the rest of the market has done. But yeah, I think the last slide there going into some of those specific examples highlights some of those specific ones. But what I can tell you is, kind of going back to, the uncertainty surrounding FEMA and NFIP, we've had quite a few, that's kind of understating it. Over the last year, we've really seen an uptick in government, local, state interest in Parametric to backstop their resiliency efforts following natural catastrophe. So quite a bit is in the works. And one thing I'll mention about Parametric is that this is not an off-the-shelf product. This is not something that we're not a rush market where this isn't typically super small premiums either. These are thoughtful, very engaged conversations and solutions and structures that we put forward. So it may take a year, sometimes 2 years for a solution to be decided upon. So a lot of this is still developing as the need kind of intensifies within these governments.
I've got a question. Robert, can you explain how any insurance company can make a profit out of Parametric?
That's a great question. So ultimately, we are an insurance product. On its face, Parametric is a weather derivative when you think about it. So with a weather derivative, that is a pure financial hedge, that is taxed as income, that is a pure speculative product. Because we are an insurance-based product, you are not allowed to profit from this. So what I will say on the side of, on the overpayment side is if we are modeling and presenting a structure that has the potential to overpay, number one, it's a bad investment if that's the way that a client is thinking about it is, hey, we're going to make extra money on this. Number two, it's a more expensive policy at the end of the day. If there is an instance where there is an overpayment, which thankfully we have not been caught, but we haven't been in that situation. There's two remedies there. They can either return some of that payout back to us at Descartes, or they claim it as income and it is taxed just like a derivative would be. So it's really more of a balance sheet issue on their part. But like I said, I mean, we take a lot of pride in back testing these things and our structures. So we would really do our best to avoid those situations. But there are remedies if for whatever reason there is an overpayment.
I'll go ahead and ask a question. When it comes to trigger points, what's the scenario or what happens if the scenario is that you come within a fraction of your trigger point but don't hit it, and you still sustain, considerable damage?
Yep, that's a great point. And if you are concerned that you're still going to suffer significant damage and it's outside of the predetermined threshold, that comes down to our flexibility when we're quoting this account. So we really do our best, like I said, with the back testing, especially looking at prior events. So we try not to be caught in a situation. This is kind of the converse to Brian's question is, what happens in an overpayment? What happens in an underpayment? Thankfully, both instances are exceedingly rare, not only with Descartes, but in the industry. And like I said, back testing is significantly important. It can't be understated how important that is when we are modeling these structures. But I mean, we have our own modeling capabilities and we put a lot of faith in that. But at the end of the day, I mean, we do take a look at, not to the same extent that a traditional insurer would look at it, but we can take a look at the asset class. We can take a look at the building construction. We can take a look at a lot of different things, flood zones, flood certificates, elevation certificates. That'll give us a good understanding of what damage we would likely see at a given trigger thresh point. So if there is a scenario where, for the sake of example, looking at that the hurricane example, I'll go ahead and pull it up really quickly. This one attaches. The word attach means we start coverage at a Category 3 hurricane. If they're worried that a Category 2 hurricane is going to cause significant damage, we can certainly quote Category 2. What I'll say on the underpayment side is that our covers are meant to be catastrophic covers for the most part. We can take a look at things that are a little bit more frequency versus severity, but really a parametric policy functions best at a catastrophic event. So it's highly unlikely that we would structure something where there would be an underpayment. It's very likely that they're going to be able to find a justification for those lost dollars, and we try to structure something that will respond to those catastrophic events. So I hope that answers your question.
Yes, thank you. I think we had
another one pop up in the chat.
Yep. You want to read them or you want me to?
Yeah. So with the unpredictability of natural disasters in terms of project impact, what would trigger a cancellation after a payout? I guess, could you clarify a little bit more on what do you mean by a cancellation after a payout?
I guess with the traditional products, can you hear me okay?
Yeah, I got you.
Okay, with the traditional products, one of the things that we hear a lot from homeowners, at least with housing, is that, and I think we see the situation out in Florida and other states where you had the Helene and the impact being far more than was projected. A lot of concerns about cancellations of policies after a payout and the inability to get continued insurance. And I guess I'm also really concerned because, if we thought Helene was bad, we were just looked at Melissa in the Bahamas, which is something I don't think as far as the analytics could have predicted that when people are saying it was off the scale. So just wondering, for a governmental entity that's trying to build resiliency, what might lead to a cancellation? But clearly, if you have to go through all these hurdles to create this product.
Yeah, so that's a fantastic question, and we have a completely different approach to risk than a traditional market in that sense. So when we look at the timescales and when we would expect losses to occur, we're looking at geographic timescales. So not only can you expect rate stability, where we're not going to increase pricing year to year at all. Really what you're looking at is if we sustain a loss or even back-to-back losses or back-to-back-to-back losses, we hold still with our modeling that is not a super likely event. We're pricing these things on their independent, merits and their probability of being impacted by a storm. So that doesn't change from year to year really all that much. So to answer your question briefly, we've paid out claims within a week of a policy being incepted, full limits. And not only did we renew it with that exact same structure, exact same terms, they increased their limits more often than not. So Parametric really does best when there are claims. It's kind of unfortunate that it's, the product shines when we actually get to see it in action, because the downside is obviously these insureds are being impacted negatively. But once they do receive a parametric payout, they typically, reinforces the value of what Parametric brings to the table. So, because we're looking at these long geographic timescales as opposed to, different carriers in the traditional markets that are very year-to-year focused, we do not cancel non-renew policies because of losses.
Thank you. And my second question is, do you currently have any providers? Are you operating in the state of South Carolina? And kind of what has been the response of insurance regulatory commissions, since this is a fairly new product?
Yeah, absolutely. So we write in every country unless you are Russia or North Korea. So South Carolina is certainly not an issue for us. We actually have a gentleman who's my counterpart in Western North Carolina. So he handles quite a bit of that. But from a regulatory standpoint, I mean, we're certainly not the only parametric market out there. Parametric has been within the insurance industry since the 80s. A lot of this goes back to Bermuda insurance. So, from an insurance regulatory standpoint, this is kind of old news to them. I think it's new news to a lot of us because it's starting to come to the forefront a whole lot more. But insurance regulators and lenders have been seeing this for quite a while. If you'd asked that specific question about lenders 2 years ago, I would have said it's a little bit wishy-washy on that front. But because lenders have seen that Parametric acts the way that it's supposed to, and that we're paying out claims, and that we, especially at Descartes, are financially stable, I can't tell you the last time I've had a lender raise any specific questions. And to that extent, I don't believe a regulator has ever called into question a parametric policy. Unless it's something on a government level where they're involved in it and they have preconceived notions. But typically we're able to talk through those, and that's one of the big values of pulling someone like myself into those conversations and our underwriters, is that we're happy to massage some of those questions and address their concerns. And typically once we kind of fall back on our track record and often point them in the direction of other folks that might be outside of their world, it definitely helps alleviate some of those concerns. So short answer is it's really not an issue we're running into.
Thank you.
You're very welcome. Thank you for the question. And Brian, we had another one from you. Would the policy holder typically be a community for parametric approach, or could state? So once again, it comes down to the flexibility of parametric. Whoever has an insurable interest, as long as you have an insurable interest at the end of the day in what you're covering, that entity could be, a state government. I don't know that I can say which federal governments we backstop, but they're certainly in North America. So not only are we doing this on a small local government, state level, we do provide, backstopping for multiple perils for federal governments. Let's see, we have another one here. Has Descartes worked with hospitals in providing parametric insurance to build resilience? Hospitals are a huge asset class target for us. We see quite a bit of that, especially as it pertains to the utilities around the hospitals. So a lot of these hospitals are very robust structures that can sustain, quite a bit of, especially, straight line wind damage, hail even. What we see a lot is tornado and hurricane covers, the truly catastrophic, and wildfire and earthquake as well. But yes, hospitals are huge for us. We do a lot of interruption coverage for them, right? Like I mentioned, where maybe hailstorm, it doesn't take out their building, but it takes out the utilities around them. And that's another good point about parametric. We don't have to be triggering off of their physical building. We could be triggering off of, in the case of an e-commerce business, we could trigger off of their airport that's 50 miles away, but that's their sole source of shipping and receiving goods. So even though they actually don't have any claim to that airport, it's an insurable interest insofar as that they are looking at a business interruption claim should that airport go down for a hurricane, tornado, hail, whatever that event happens to be. So we're incredibly flexible, and yes, hospitals are a large focus of ours. You guys have been asking some really good questions. I really appreciate that. I think we probably have time for one or two more if anyone has anything else, but if not, I'm happy to give everyone 5 minutes back to their day.
Can you, if nobody else has anything, would you talk about how the Jamaica one worked? Didn't they use a barometric pressure as the variable?
Yeah. So when we talk about the parametric options that was implemented for that specific case, there were a number of different markets within that program, and there's actually 3 or 4 different programs that triggered. I believe one triggered 50 million in coverage, one was 65 million in coverage, and one was, I can't remember what it was lower than that. But typically when you have multiple parametric markets within a program, you can see them approaching risk in a different way. I believe the one that you're mentioning specifically, it was a dual trigger of barometric or central pressure and cat in a circle. So these are all capabilities that we have as well. So when we look at this cat in a circle approach that I used as an example, we can quote wind at location, we can quote barometric pressure, we can quote, really anything that you want that any other competitor is using, we have the ability to use. But we do have preferences on which ones we feel like correlate better with the actual losses itself. So fantastic question.
I understand that in the year prior, one of the hurricanes missed barely, but still damaged Jamaica, and so they missed out on the variable.
Yeah, I don't know specifically about that. I'd have to look into specifically what that one was, but that could certainly be the case. And to that point, you know, if you are concerned with sort of a glancing blow, or maybe there has been an experience where, you know, parametric policy hasn't paid out, you know, we can look at why that happened and design a structure that, you know, is more comprehensive and is able to address, you know, why specifically that happened. I know following Helene and Milton, you know, that was more of a rainfall event than a wind event. So that's why we started, you know, taking a look more at surge in the western Gulf Coast of Florida, as opposed to maybe, you know, wind-based coverage. So we're constantly evolving and refining our process. But, you know, that being said, we have a high level of confidence in the policies that we have in place currently.
Thanks, Robert.
Appreciate all the questions.
Robert, thank you so much again for being here. Really excited that we had so many great questions and folks on the call. We will be sharing out the recording, as well as putting together any Q&A that correlates to all of this as well. Robert, I'm not sure, did I see on the screen there your contact information for folks to reach out to you if they are interested?
Would we be able to just send a quick email blast out to everyone following
Sure
this?
Yep. We will include that for y'all in there. And once again, thanks y'all for being here.
Thanks, everyone.